Welcome to the Deep Dives.
Wow.
We cut through the noise so you can get smart fast. Today we're diving headfirst into the explosive growth of exchange-traded funds, or ETFs.
Mm-hmm.
These aren't just some niche investment anymore. They're on a rocket ship, predicted to reach a staggering $30 trillion in assets by 2033.
It's a truly phenomenal trajectory, yeah. I mean, these numbers aren't just big. They really signal a fundamental shift in how investors are building and managing their portfolios.
And that's precisely our quest today. We're not just going to chart this phenomenal growth.
Right.
We want to pull back the curtain on why investors are flocking to ETFs.
Right.
And we're specifically zooming in on how they're becoming powerful tools for those looking to generate income, whether that's through high yield or dividends.
Exactly. And to guide our deep dive, we've pulled from some fantastic sources. There's the comprehensive 2025 Global ETF Investor Survey by Brown Brothers Harriman.
Okay.
Some really good insights from Investopedia on the pros and cons. A pretty candid Reddit discussion on ETF performance.
Oh, interesting.
And detailed explanations from ICI and Charles Schwab on how these things actually work and compare to other stuff. So, yeah, a rich tapestry of info.
Great. So let's unpack this, giving you a shortcut to being truly well-informed about, one of the most dynamic areas of modern investing.
Mm-hmm.
So when we talk about explosive growth, the numbers from that 2025 Brown Brothers Harriman survey, they don't just paint a picture. They practically shout it from the rooftop.
I agree.
I mean, consider this. A massive 96% of surveyed investors intend to increase their ETF allocations over the next 12 months.
96%.
That's up from 82% just last year.
Yeah.
When you see that kind of shift, what's the big takeaway for you?
Well, that 96% figure is truly telling, but here's where it gets really interesting for me. 63% of these investors now rate ETFs as their top choice for fresh capital.
Top choice. Wow.
Yeah. They're choosing ETFs over traditional stocks and even bonds as their primary vehicle for new money.
Yep.
This isn't just confidence. It feels like a, structural realignment of capital.
Mm-hmm.
It suggests investors see ETFs as maybe the most efficient and versatile tool for future growth.
And the asset growth backs that up, doesn't it? ETFs jumped a staggering 27.7% last year alone.
Incredible number.
Going from $11.51 trillion to $14.77 trillion globally. Plus, 75% of investors have boosted their ETF allocations over the past 5 years, and nearly a fifth, 19%, increasing by over 25%. It's not just a blip, it's sustained.
Absolutely. And this growth also reflects a pretty remarkable evolution. ETFs started as these relatively simple, passive index tracking products.
Right, just mirroring the market.
Exactly. But today, they've really transformed. We're seeing a marked shift towards highly specialized investment strategies. Think smart beta ETFs, which use alternative indexing methods alongside actively managed ones, derivative-based, alternative, even cryptocurrency ETFs. It's way more sophisticated now.
That is a global thing, too, right? Europe's celebrating its 25th ETF anniversary.
Yeah, that's right.
And places like Luxembourg and Ireland are actually fostering growth with their regulations, especially for active and multi-share class structures.
Yeah.
Are there complexities with that global spread investors should maybe know about?
That's a good point. I mean, global expansion is great for diversification, but yeah, you do need to understand the different regulatory environments and market structures.
Sure.
But overall, ETFs are really benefiting from powerful tailwinds like intergenerational wealth transfers. Vanguard thinks $18.3 trillion will transfer by 2030.
Wow.
And these younger, often more tech-savvy investors, they seem really drawn to the transparency and flexibility of ETFs. Plus, we're seeing investors actively reallocating capital, mostly from mutual funds.
Okay, how much?
Around 29% from mutual funds and actually 23% from other ETFs. So it's a significant reshuffling happening.
So we've seen the explosion in numbers, but why? What's really driving investors to dive so deep into ETFs? What are the core motivations?
Well, it's a mix of powerful drivers. Portfolio outperformance through, say, tactical or niche sectors is a big draw for about 32%. Then long-term growth via efficient, lower-cost core holdings for 31%. But there's a broader set of reasons, too, which kind of speaks to how versatile ETFs have become.
That's interesting. Like what?
Well, 23% are now using ETFs for volatility and risk management or, for downside protection.
Right.
And crucially, for our deep dive today, 13% are specifically looking to generate income.
Ah, there it is. The income piece.
Mm-hmm. And you mentioned priorities shifting earlier. This fits right in.
How so? With a traditional focus on, say, low costs.
Yeah, exactly. That emphasis on the expense ratio, which, used to be almost everything.
The number one thing.
Right. It's actually subsided quite a bit. Professional investors now rank it 8th in importance. Yeah. So what this tells us is, while cost still matters, investors are increasingly valuing the benefits ETFs provide, things like access to institutional asset managers or specific complex strategies, maybe even more than just the lowest price tag. They seem willing to pay a bit more for that added value or specific outcome.
Right. So let's zoom in on some of those specific strategies gaining traction, especially the income-focused ones. We're seeing strong interest in buffered ETFs for risk management. Nearly 30% expect to invest in these. It's a $45 billion asset class already. Can you just quickly explain what a buffered ETF is?
Sure. Think of them as having a sort of built-in shock absorber for your portfolio.
Right.
They're designed to give you some market upside, but with a predetermined limit on how much you can lose over a specific period, like a year.
So protecting the downside.
Exactly, protecting your downside while still participating in the market. That's why nearly a third of investors are interested.
Got it. And what about fixed income ETFs? Similar appetite there?
Definitely. There's a significant appetite, also around 29%. And within that, you see specific preferences emerging.
Like?
14% are keen on U.S. investment-grade corporate bonds, 12% on U.S. Treasuries.
Okay, the safer stuff.
But also another 12% specifically on high-yield corporate bonds.
So going for more income, potentially more risk?
Precisely. It clearly points to an increasing interest in generating income, even if it means moving a bit further out on the risk spectrum where those higher potential returns are.
And this brings us neatly to another area of growing interest: dividend and income ETFs. A significant chunk, 22% of investors, plan to invest in these. But Investopedia adds a bit of nuance here on the yields, don't they?
They do, yeah. Investopedia points out that while these dividend-paying ETFs exist, their yields might not always be as high as picking individual high-yielding stocks yourself.
Why is that?
Well, because the ETF tracks a broader market, right? So it averages out the yield across lots of companies, some high, some lower.
Okay.
But the trade-off is usually lower risk compared to holding just a few individual high-yield stocks.
Yeah.
You get that diversification benefit.
Right, spreading the risk. Which leads us perfectly to this real-world example from Reddit you mentioned. Someone shared that SCHT, a popular dividend ETF,
Yeah, SCHD, very popular.
had 5-year growth of about 54%. But another user, pretty bluntly, called it such a turd. Chuckles slightly. Yeah, that's putting it mildly.
That's some strong feedback. What's really behind that kind of reaction to what still sounds like pretty decent growth?
Well, that colorful feedback really hits on a crucial point.
Yeah.
It's all about context, isn't it? In recent years, well, look, a 54% return over 5 years isn't bad by any normal standard.
No, not at all.
It just hasn't kept pace with the truly explosive, almost once-in-a-generation growth we've seen in those American mega-cap tech stocks.
Right, the Magnificent Seven effect.
Exactly. So for someone comparing SCHD to, say, an ETF loaded up with those tech giants, their perception might be that it's underperforming, even if SCHD is doing exactly what it's designed to do, focus on dividends, value, maybe lower volatility.
So it highlights the difference between growth versus income investing.
Precisely. And that there's no single best ETF, only the one that actually aligns with your specific goals, whether that's high yield, steady dividends, or pure growth. That makes perfect sense. And this search for maybe different kinds of performance ties into another huge trend: the flight to active ETFs.
Oh yeah, this is massive.
Almost all investors, a staggering 97%, plan to increase their exposure to active ETFs in the next 12 months. That's a huge jump from 78% last year.
It really is. It indicates a significant potential increase in active traction. Actively managed ETFs hit a record $1.17 trillion in assets under management at the end of 2024.
Wow. And why are investors flocking to them?
The main reasons seem to be, 1, getting access to institutional asset managers or specialized strategies they couldn't get otherwise.
Yeah.
2, having more transparency into the underlying assets compared to a traditional active mutual fund. 3, access to specific investment strategies. And 4, potential tax benefits compared to actively managed mutual funds.
So we're seeing a direct capital shift here then.
Definitely. Investors are actually moving passive allocations into active ETFs.
Right.
About 33% plan to do that. And get this. More than half, 53%, actually plan to sell their existing index-based ETFs to fund these active ETF purchases.
So they're actively chasing alpha.
It certainly looks like a clear search for alpha, that outperformance, even if it means paying a higher expense ratio. We're talking around 0.73% for active versus 0.43% for passive, on average.
Which brings up an important question for maybe some listeners. What exactly is an ETF fundamentally? How do they work behind the scenes to get this efficiency and transparency?
Yeah, good question. At its core, an ETF is a pooled investment vehicle, right? Its shares trade intraday on stock exchanges, just like individual stocks. And inside, they hold a basket of underlying assets, could be stocks, bonds, commodities, whatever the ETF tracks.
And a crucial part of their mechanics involves these authorized participants, or APs. You hear that term a lot. Why are they so important?
They're absolutely fundamental. APs are typically big financial institutions, and they operate in what's called the primary market for ETFs. What they do is directly create and redeem large blocks of ETF shares called creation units by exchanging baskets of the underlying securities, or sometimes cash, directly with the ETF fund.
And how does that help me, the average investor, buying on the exchange?
Great question. Because of this constant arbitrage activity by the APs, they're always watching for tiny price differences between the ETF shares trading on the exchange and the value of the underlying assets.
Right.
They step in and buy or sell either the ETF shares or the underlying securities to capture that difference. And that action is what keeps the ETF's market price remarkably close to its net asset value, the NAV.
So it ensures you're getting a fair price, basically.
Essentially, yes. It means you're almost always buying or selling an ETF at or very, very near its true underlying value. It's a huge benefit and a key difference from, say, closed-end funds.
That's fascinating. And the scale's pretty big in 2024. 65 APs had agreements, 43 were active, and the top 5 did 2/3 of the activity.
Yeah, and on average, each ETF has about 20 registered APs and maybe 4 actually active on any given day, all helping maintain that price discipline.
And transparency is key to that, right? Seeing what's inside.
Absolutely. Transparency of holdings is crucial for that price reflection and for investor confidence. While most ETFs are fully transparent, we are seeing some semi-transparent or non-transparent active ETFs gaining a bit of traction, especially with regulatory changes in Europe. Still a small slice, but growing.
Okay. So if you're trading ETFs yourself, what are some smart tips to keep in mind?
Good question. First, probably try to avoid trading right at the market, open or close, say, the first and last 15 minutes.
What's that?
Just generally higher volatility and often wider bid-ask spreads then, meaning you might not get the best price.
Okay, makes sense.
And importantly, always consider using limit orders.
Instead of market orders.
Yes, especially for less liquid ETFs where that gap between the buying price ask and selling price bid might be wider. A limit order lets you specify the maximum price you'll pay or minimum you'll accept.
Good tip. What else?
For international ETFs, maybe think about the time zones of the underlying markets. Trading when those markets are open can sometimes help minimize tracking errors.
Ah, interesting point.
And this next one's critical. An ETF's true liquidity really comes from its underlying holdings, not just its average daily trading volume on the screen.
What do you mean?
Well, an ETF might trade millions of shares a day, but if the stuff inside it, say, niche bonds or small cap stocks, is hard to buy and sell quickly, the ETF itself might struggle under stress. So look beyond just the trading volume.
Got it. Look at the underlying asset's liquidity, too.
Exactly. And finally, for very large orders, it's usually wise to work through a broker. They have ways to execute large trades with minimal market impact.
Okay, great practical advice. Now, we've talked a lot about ETFs themselves, but how do they stack up against the things people are more familiar with, like mutual funds or just buying individual stocks?
Yeah, the comparison, especially with mutual funds, is really important. They share similarities, right? Both are managed baskets of securities offering diversification. Both can be passive index trackers or actively managed.
Right, but the differences are key. Trading, for instance.
Huge difference. ETFs trade throughout the day on exchanges, like stocks, prices constantly moving, mutual funds. Only once per day at the end of day net asset value, or NAV.
Minimum investment is another one.
Yeah. You can often buy an ETF for just the price of one share. No big minimums. Mutual funds often have flat dollar minimums, sometimes thousands of dollars, although they do often allow fractional share purchases.
And costs, how do they compare?
ETFs have explicit costs, maybe commissions, though often zero now, and the expense ratio, plus implicit costs like that bid-ask spread when you trade.
Okay.
Mutual funds might have sales loads upfront or deferred charges or redemption fees, plus their ongoing operating expenses, which includes the management fee.
And you mentioned tax efficiency earlier as a big ETF advantage.
Yes, generally speaking, ETFs are more tax efficient. This is largely due to lower turnover in index ETFs and that in-kind creation and redemption process we talked about.
How does that help with taxes again?
Because the APs are swapping securities, not cash, the ETF manager usually doesn't have to sell underlying holdings to meet redemptions. Selling triggers capital gains. So ETFs tend to pass on fewer, if any, capital gains distributions to their shareholders compared to mutual funds.
Which can save you money come tax time.
Potentially, yes. Mutual funds, especially actively managed ones with higher turnover, often have to distribute those taxable gains.
What about dividend reinvestment?
Open-ended ETFs typically reinvest dividends immediately, which helps with compounding. Mutual fund practices can vary a bit more, except for unit investment trust ETFs.
So putting it all together, when might you choose an ETF over a mutual fund, or vice versa?
Well, ETFs often make sense if you're an active trader, if you value that intraday liquidity, or if tax efficiency is a major concern. They're also great for accessing specific strategies, like those income-focused high-yield or dividend strategies we discussed.
Okay, and mutual funds.
Index mutual funds can still be great, especially if you're investing small amounts regularly, like dollar cost averaging, since you can often buy fractional shares easily. Or perhaps if a similar ETF is very thinly traded.
And active mutual funds.
Actively managed mutual funds might still be preferred if you're seeking potential outperformance in less efficient markets. Think areas like high-yield bonds, maybe some emerging markets where a manager's skill and research can potentially add more significant value.
Okay, that makes sense. This brings us to strategic allocation then. Where and when does active management, whether in an ETF or a mutual fund, really have the best chance to shine? It's not always passive is best, right?
No, definitely not. It's rarely an either-or situation. Both active and passive strategies usually have a place in a well-rounded portfolio. It's really about finding the right mix for your specific goals and risk tolerance.
So where does active tend to do better?
Generally, the opportunity for active managers to generate that alpha or outperformance is greater in less efficient markets.
What makes a market less efficient?
Things like fewer analysts covering the stocks, lower institutional ownership, think U.S. small caps, maybe international developed stocks outside the big names, and especially emerging market equities. There's just, more potential for mispricing that a skilled manager can exploit.
Interesting. And what about fixed income? You mentioned high yield earlier.
Yes, fixed income is fascinating. Despite maybe seeming less volatile than stocks, bond markets are huge, complex, with tons of individual securities, and a lot of trading happens off exchange. It's actually quite difficult to replicate perfectly with a passive index.
So that creates opportunity.
Exactly. It presents a potential opportunity for an active manager who can navigate that complexity, maybe find value in less liquid pockets or make tactical calls on duration or credit quality. So for specific areas like high-yield corporate bonds, active management can be particularly compelling.
Are there certain market environments where active tends to do better or worse?
Generally, yes. Active managers often perform better during market downturns.
Why is that?
They have the flexibility to adjust positioning, maybe raise cash, or tilt defensively, unlike a passive fund that just has to hold the index components. They also tend to do better in periods of high dispersion.
High dispersion, meaning?
That's when stocks aren't all moving together in lockstep. Some go up, some go down, lots of variation. This gives skilled stock pickers more opportunities to find winners and avoid losers.
And when do they struggle more?
Narrow bull markets can be tough. Think about 2023, driven largely by just a handful of mega-cap tech stocks, the Magnificent Seven. It's hard for a diversified active manager who might be underweight those few huge winners for risk reasons to keep pace with an index dominated by them.
Makes sense. So looking ahead now, what does the future hold for ETFs? It seems like innovation isn't slowing down.
Not at all. A really significant trend is the growing integration of AI, artificial intelligence.
How is it being used?
Well, the survey showed 31% of firms are now using AI-driven tools for actual investment decisions, and another 30% are deploying AI for market analysis and research. So technology is becoming deeply embedded.
Interesting. And we're also seeing rising interest in alternatives in crypto ETFs.
Definitely. 26% of investors expect continued growth in alternative investment ETFs like private equity or hedge fund replication strategies. That jumps to 38% in the US.
Dang crypto.
A huge number, a whopping 71% of allocators expect to increase investments in cryptocurrency ETFs. Demand seems highest in Greater China in the US.
Wow, 71%.
Yeah. Although it's important to note there are still regulatory question marks, particularly from the SEC, around things like liquidity risk and how you accurately value assets in some private market ETFs. So, still evolving.
But overall, this incredible growth, this innovation,
Yeah.
it really puts us on track for that $30 trillion trajectory for global ETF assets by 2033, doesn't it? Maybe even faster.
I think so. The growth rates in 2023 and 2024 significantly outpaced the longer-term average, so the conviction in the market is definitely clear. ETFs are proving to be incredibly adaptable, efficient, and increasingly diverse tools for investors all over the world, addressing a much wider range of needs than ever before.
Okay, so let's wrap this up. What does this all mean for you, the listener?
Well, ETFs are clearly a rapidly growing, incredibly versatile investment vehicle. They're increasingly used for diverse strategies, including, as we discussed, generating income through high yield or dividends. And there's a very clear shift towards using active management within the ETF structure.
So our final thought for you today is this. Given the increasing sophistication and the sheer variety of specialized ETFs now available, and considering how market conditions and regulations keep evolving, what aspects of your own investment strategy might you now reconsider to best leverage these evolving tools for your specific goals, whether that really is high yield, steady dividends, risk management, or something else entirely, something to think about.